Today, we're looking at the new data that's come out overnight, suggesting that the UK and Japan have entered a technical recession. Is this specific to their economies, or is it due to global factors? Let's find out. And the trading takeout today is going to be why you shouldn't enter a full position with just one single position. But first, make sure you like and subscribe to the channel so that I can pop up in your YouTube feed every single day to improve your trading edge. So it's not been the best of evenings or mornings for the UK and Japan. Japan data came out last night, the GDP growth data, and we can see here it's just a sea of absolute red. So if we just run through it very, very quickly, quarter on quarter Q4 growth was negative 0.1%. The quarter on quarter annualized, though, was negative 0.4%, which was a massive miss on the expected of 1.4%. Now, the UK, we've got to switch over just to today's date. So if I do that very quickly, we can see that we came in at negative 0.3% with the expectation of negative 0.4%. That was, negative 0.1%. That was on the quarter on quarter data. And then the GDP preliminary data for the year, so year on year, negative 0.2 versus negative, 0.1. I'm going crazy today. I'm talking about negatives too much because it is pretty negative. Some of the saving graces here, though, in the UK specifically, are the manufacturing data points, because we're seeing industrial output up versus the expected, and also we're seeing the manufacturing output. The big drag has been services, which typically have been doing quite well. If we look at the services PMIs, they've actually been doing okay. So from my perspective, it's a little bit surprising, this data. I'm not going to lie, it's a tiny bit surprising. I didn't expect it. But the thing that we need to take into account now is that interest rates are likely to start getting repriced. So if we have a look at what's the best one to look at, let's just have a look at TradingView, and then we will go on to the UK base rate, United Kingdom interest rate. There we go. I'll share this tab now. So we can see that we're at 5.25%. And so what I'm thinking, and we've remained at that level for a relatively long time, it is the same level roughly as 2007-8. So terrifying thought that. But what I'm thinking now is that we start to see a slight pause up here for a little bit of a longer time, and we start to see the votes at the Monetary Policy Committee start to shift back towards wanting to cut. It doesn't mean that they're going to cut. It just means that we're going to see the board members start to, or committee members start to shift towards wanting to cut. So they're going to become more dovish. And this is naturally in response to this poor growth, but there are caveats here. This growth is for the previous two quarters. This quarter is actually meant to be quite strong. So this is why I'm saying that they're going to remain unchanged for a little while, until March, probably, until we see what this growth looks like. But also on top of the growth is the inflation data. So we were flat basically on previous. We're at 4.1%, I believe. Or was it 5.1% on the headline? It was 5.1% on the headline this month, 5.1% last month. That might cause some aversion, but we'll again see up into March what that looks like, what the inflation number starts to look like. Japan is in a different situation. So Japan's got, negative GDP growth, but also they're still at rock bottom rates. If I go to Japan interest rate and we have a look there, we can see that they're still at 0%. Actually, negative 0.1% is their deposit rate. So they haven't really got that much room to go. They've not got any room to really move to the downside, which means that it could be the case that they lower the limit on the yield curve control again. So they were raising it and letting yields in the belly of the curve, the belly of the yield curve, rise. But now what they might do is just suppress it again to ensure that bond yields stay suppressed over the entire curve, not just the front side and the back side. So From my view, it's going to have to be a case of, for Japan, reining in some of the negotiations on wages, which has been going on for quite a while now, and they were looking to move into April, and the market was actually pricing a rate hike, funny enough, in April. I think that's totally out the window. I think growth slowdown is taking full control here, and they're going to have to suppress that, which is strange going into a low growth environment, saying, okay, we have to suppress wages now, but that's how things work, I guess. Trades off of this, I guess one standout could be on sterling yen, purely because we might be looking at the extent to which this divergence actually occurs now. So we've got two economies that have gone into technical recession at the same time. What do the changes in interest rate pricing look like? The trend for sterling yen is still to the upside, and I think this is because it carries a lot of risk sentiment positivity. So with stocks still ticking up, we're still seeing the pound get a bid. Partly why the pound got a bid yesterday as well. Today, not so much, but I'm still slightly favourable towards sterling. We're still, above these moving averages. It's a little bit flat. My only worry will be if we completely collapse through here and we start trading maybe like 1.24. You could probably start looking at targets of 1.2, 1.5, which is about roughly there, and then lower at 1.2. Those are the real key levels, and I think this was a relatively key level where we started to get this bit of demand in here into the market, crossed over the moving average, and we restarted the trend to the upside basically. So that's really where I would be focused. I think there's been a lot of sellers to the upside here as well, so there's sort of dual targets. If we start to tick well above what we're talking about here, 1.26, I think these highs would be in play. But for me right now, the bias is towards the downside, towards 1.21, which is tricky for the Bank of England because it can induce inflation again, which is not something that they want at this time. What do you think the number one issue is with retail traders? I mean, from my experience and what I know, it is always position sizing. People always over leverage, and the anxiety of entering the market ends up creating poor decisions. Now, what can you do to resolve this? Well, rather than take that initial large position where you're worried about where the market's going to go within the first 2 minutes, split it up. Split it up into 4 different positions so that it's nice and small, so that you're giving yourself time to be comfortable and understand that ticks up and down happen, and you can kind of feel massaged and relaxed by the market, because that is the number one thing for most people, is that, there's lots of people that talk about trading psychology and things like that. At the end of the day, what you want to try and avoid is being scared, is being fearful. And the way that you do that is by de-risking a little bit. Wait for the market to let you know that you're right, and then add in your bigger positions.